Markets are very overbought. We're very extended. This rally that we had that started in November is extremely long in the tooth. We're up 15 out of 17 weeks. That's the longest stretch since 1989. That doesn't mean the markets are going to crash, but there's a real possibility that sometime between now and the election, we're going to have a 5 to 10% correction. So whatever the market gives you between today and the election, the market's probably going to give it up at some point.
Hi folks, Adam Taggart here, Thoughtful Money and founder and host, with a quick public service announcement before we get to this week's weekly market recap with Lance Roberts. The early bird price discount, the lowest price we're going to be offering for Thoughtful Money's online conference on Saturday, March 16th, just ended last night if you're watching this Saturday morning when this video launches. Now, I always get a ton of emails from folks the day after saying, oh, I just missed the deadline. Can I please get that lower price? Well, I'm letting everybody know that one time only, I'm extending the deadline to midnight tonight. So if you missed last night's deadline, you can still sign up for that lowest early bird price discount today. To go lock that in, just go to thoughtfulmoney.com/conference. And remember, if you're a premium subscriber to our Substack, you also get an additional $50 off of that with the savings code that we sent your way. All right, folks, hope to see you at the conference. Now, enjoy this week's weekly market recap with Lance Roberts. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week, featuring my Janusian friend, portfolio manager Lance Roberts. Hey, Lance, how you doing?
Good today. Well, you're really working the thesaurus here.
I am. I've got that thing working overtime. So I picked the word Janusian, which is derived from the Roman god Janus, who was the two-faced god, the two sides to him.
Thanks. So you're calling me a two-faced friend. I appreciate that.
Yeah. I didn't mean it so much for your friendship, in terms of your friendship, but I want to put up two contrasting headlines here. Okay. Yesterday we heard from Ray Dalio. And he said, quote, the stock market doesn't look very bubbly, right? At the same time, same day, we had Bank of America put out a report that said the S&P is egregiously expensive. So how do we square these two? Is one of these closer to right? Could they both be right here? We're in this market right now where to some observers, it looks clearly irrational exuberance is back and valuations are super stretched. But some others are saying, hey, it's Goldilocks time and the water's fine. Jump on in.
Well, so you've got two different things that are going on. So again, what Ray Dalio is saying is like, yeah, this market doesn't look bubbly. That's a sentiment issue, right? So that is, when you go back and look at 1999, 2000, investors were paying up massively for companies with no earnings and no revenue. Bank of America is talking about the fundamentals, right? Valuations. And yeah, you look across, 20 different metrics of the S&P 500, they all are trading between 80 and 95% of their historical deciles. So yeah, the market is expensive. There's no arguing that we're overpaying for the earnings and revenue growth that we're getting. That's correct. On the sentiment side, we're not yet at bubble levels in terms of sentiment. Now we're approaching that level. We're starting to get to that level in terms of sentiment, but there's still more room for that to go. Again, this is, if you think about the dot-com bubble in 1998, markets were just starting to scream higher. And we were talking about valuations and those type of issues in 98, and then 99 and 2000, it just, the sentiment just went bonkers at that point. And, I tell the old story about I'd walk into I had a brokerage firm back then that I owned, and I'd walk in the morning, I'd open up the computer at, 8:15, I'd load up trades for SDLI and JDS Uniphase and some of those similar type companies back then. And market would open at 8:30, I'd be up 100 points in every one of those stocks. I'd close them out and go home for the rest of the day because that's all you had to do. We're not there just yet. We're seeing some of that beginning to occur, but we've probably got more room to go before we get to that bubblicious type sentiment, so to speak. So a little bit, so they are talking about the same thing, but on two different aspects.
Okay. Okay, now I'm going to go to a couple of headlines written by some guy who I think is very smart. One
It's
of which is titled, "This is Nuts. An entire market is just chasing one stock." So I
that
kind of
guy's a
gave you the
total.
two
I know
different.
that guy. He's a total idiot. I wouldn't listen to anything he's.
Well, okay, so we've kind of got Dalio over here, we've got BofA over here. Where does
Yeah.
Lance Roberts fit in there?
Well, so the note of that article was that back in January of 2020, if you go back, if you can strip out everything post 2020 and just go look back at the market in 2019 and early in January, February of 2020, the market was just going parabolic. And we were talking back then very much the same thing we're talking about now, is like it was just kind of insanity in the markets. Valuations didn't matter. People were just piling into stocks. And nobody was expecting any type of economic event. It was a Goldilocks economy. Economists were like, oh, growth is going to be awesome this year. The markets are only going to go higher from here. Predictions for the S&P were up 8, 9, 10, 12% for the year. And so we wrote an article in January of 2020 saying, hey, this is nuts. When your portfolio management meeting starts and ends with this is nuts, it's probably time to take some money off the table. And so if you go back and look at that period, it's very similar to where we are now, that same type of attitude. This is a can't stop, won't stop market. This is a nonstop bull market. The train's just getting on. And at the same time, analysts are now coming up with all types of ways to justify current valuations. But if you take a look at stocks in the S&P 1500, we have numerous stocks that are trading well above 10 times price to sales. If you don't understand why 10 times price to sales is important, I've got a link to an article in that piece talking about that and referencing what Scott McNeely said back with Sun Micro in 2000. But you got, a company like NVIDIA. Just as an example, NVIDIA just announced earnings, 400 billion, 400 billion in revenue growth. I mean, they're just blowing the cover off the ball right now in terms of earnings growth. So, okay, we can say that, yeah, the earnings will catch up with the price of NVIDIA. This is assuming, of course, NVIDIA stock stocks keep going up every day, which it just continues to go higher. But if the stock would stop going up, yeah, earnings would eventually catch up with the price and you could justify the valuation, but that's not what's occurring. The stock trades at 32 times price to sales. So whatever Scott McNeely said, back in 2000 about 10 times price to sales, and I'll save you the reading if you're lazy, but what he said back then is that at 10 times price to sales, in a nutshell, I can't pay taxes, I can't pay employees, I can't pay operating expenses, I can't invest any money into R&D. Most of that is illegal. The other parts of it, I can't pay any dividends, I can't do any return to shareholders, which is not going to make my shareholders happy. In other words, every dollar the company makes at 10 times price to sales has to go back to the shareholder. And it's just not possible and it's not reasonable. Of course, that was the peak of the market back then too. So you're talking about 3 times that for NVIDIA. But again, it's hard to ignore the rapid growth rate that is occurring with NVIDIA. Now, juxtapose that with the second most expensive stock in the S&P 500 or the S&P 1500, trading just behind NVIDIA, Wingstop, which makes chicken wings. Now, you mean to tell me that Wingstop can grow earnings and revenue as fast as NVIDIA? And so that's the point that we are at in this market, where we are assigning growth expectations to companies that are absolutely unrealistic. And as investors, this is where we need to start paying a bit of attention to where markets are, where markets are trading. Fundamentals don't matter in the short term, right? So over the next 12 months, this market will probably be higher than where it is right now, because fundamentals don't matter in a 12-month period. Fundamentals matter over a 5 or a 10-year period. And what fundamentals are starting to tell us is that the risk to the markets over the next 3 to 5 years is growing inherently. In other words, we're suggesting that at some point we're going to have a much more severe contraction to realign what consumers are paying for stocks versus what they're actually worth relative to economic growth. Because without the economic growth is where earnings and revenue come from. And that those two are just grossly misaligned right now.
Okay, they're grossly misaligned. We have a lot of companies trading over 10 times sales or whatnot. Hearing that, it's hard again to look at Dalio and be like, really? Like not very bubbly? Because that feels very bubbly. Like, could it go higher? Yeah.
Absolutely.
We lived through the dot-com era. We watched the meme stock craze, right? We know that when the herd starts going bananas, the price can go anywhere in the short term, right?
Right. Just be careful with Dalio. Dalio says some crazy shit every now and then. Like, he said, cash is trash in 21. So, in 22, cash was the best place to be in 2022. So he says this stuff. It gets headlines. People pay attention to him because he's a very smart guy. Don't get me wrong. He runs a massive hedge fund, but him, Bill Gross, a lot of these other people that make headlines, they just say stuff kind of out their ass just to get headlines and to say stuff. But in reality, a lot of that stuff never comes true. The market does other stuff. Bill Gross was saying that, interest rate back in 2013, interest rates were going to go to the moon and they went to zero. So, it's all, these all sound great and stuff like that. But, you focus on the fundamentals, ignore what these people saying, because more often than not, they're wrong. Even Jeff Gundlach was talking about interest rates going astronomically higher in 2013, and he was dead wrong too. So even Jeff Gundlach is wrong from time to time. Everybody's wrong from time to time. And that's why it's always important to pay attention to what's actually happening in the market versus what people are running their mouth about.
So totally agree. And nobody has a crystal ball. Nobody gets it right all the time. Right. I just wanted to suss out.
Aggies always get it right. So
yeah, it's spoken like a true Texan. But I just wanted to suss out where you are, and it sounds like you are more of like, yeah, there are real reasons to be concerned. Real reason to be concerned. Again, the judgment day may be further off than we can imagine still, but yeah.
But let me be clear about the article. So right now in our portfolios, we are starting to do a little bit of risk management. So sorry
to interrupt. You're doing more risk management because you always have risk management somewhere in the portfolio.
Well, correct. But we're being proactive now about taking risk. Last week we talked about trimming off AMD and Nvidia prior to their earnings. And that's fine. And those stocks have continued to go up, but we're not selling the whole position. But we're starting to do little nips and tucks here and there in the portfolio, just because we understand that risk is becoming a little bit more egregious. Markets are very overbought. We're very extended. This rally that we had that started in November is extremely long in the tooth. We're up 15 out of 17 weeks. That's the longest stretch since 1989. And that doesn't mean the markets are going to crash, but there's a real possibility that sometime between now and the election, we're going to have a 5 to 10% correction. So whatever the market gives you between today and the election, the market's probably going to give it up at some point. And then after the election, we'll probably get a rally in the year, and we'll probably finish up the year in positive territory. And that's one of those, by the way, that's one of those really key points you've got to pay attention to when you listen to a lot of these narratives in the media. They'll go, well, every presidential election year is positive. That's a true statement. And the majority of the time, and going back to 1944, during presidential election years, the win rate in presidential election years, and I'm doing an article on this for this coming Tuesday. This coming Tuesday, I'm doing an article on presidential election years. But going back to 1944, and actually going back to 1833, the win rate for presidential election years is 76%. So 24% of the time you lost some money. 2008 was one of those years where you lost money, right? But the majority of the time, presidential election years are positive. So you go, oh, well, great. I throw my money in the market today, right? And I'm going to make money by the end of the year. It doesn't matter what happens between now and then, because Lance said that the markets are always positive. You got to be careful with that. That's positive from the first day of the year. So in other words, we're up 7%, 6-7% for the year so far. We could have a correction in the summer, which is very normal, by the way. And again, part of this analysis I'm doing for Tuesday, and we can go through some of these charts next week. But during September and October, the market typically declines in every presidential election year, even excluding the 2008 financial crisis. And normally that's because Wall Street doesn't want to be long a whole bunch of equity, depending on what's, they don't know who's going to get elected, right? So if the incumbent wins, I kind of know what I'm going to get. So and I'm talking about every presidential election year, not just this one. But if the incumbent wins, I kind of know what I'm going to get. I know that I already had 4 years of his policies. I already know how he behaves in office. I know all that. I know what his agenda is. So no big shock. What I worry about is the guy that gets elected, because whoever that is comes in, maybe he's a big advocate for, increasing taxes or cutting foreign investment or reducing the debt, something crazy like that, like, reducing the debt. That might not be good for economic growth or for the market. So I typically, as the markets, they tend to sell off prior to the election. Once the election is done, you kind of know who you get. Then markets rally, because then they go, oh, okay, this guy got elected, or the incumbent got elected, whatever it is, and he's big pro and kind of pro infrastructure guy. So they all go pile into infrastructure stocks. So that's why you typically get this correction. So look, you're up 7% this year. This summer, you get a correction that knocks off 10% of the market. Now you're negative, right, for the year at that point. And then the market rallies, and by the end of the year, you're up 1% for the year. Now you're still negative because you bought in today, the market sold off, and the market rallied into year end, and the market is positive. It's up 1% for the year. So statistically, the win rate remains, even though you're underwater. So you've got to be very careful about this analysis that gets thrown out there. It's like, oh, don't worry about presidential election years. Markets always go up in presidential election years. It's a true fact, but you can be up 0.1% at the end of the year, and it still be a true fact, even though you're deeply underwater. Which, by the way, is today's article, that small cap retail investors are still underwater even since 2022, despite this massive rally in the market.
All right. Well, you just provided the segue to what I was going to ask you next, right? So there's another article out by that guy who I'm thinking actually is maybe pretty smart.
He's still an idiot. I wouldn't listen to anything he says.
But that one's titled "Dumb Money is Back to Even, Making the Same Mistakes."
Yeah.
So what's the key lesson from that here?
Well, same thing is that, in 2021, retail investors, and so we go through a lot of charts in that about dumb money versus smart money. So dumb money is retail. Institutional money is considered smart money. And this kind of goes back throughout history. And the one thing you've got to remember is that institutions, so you listen to Ray Dalio, you listen to Bill Gross, you listen to Jeff Gundlach, you listen to Wall Street experts, you listen to all these people, right? Even CNBC, mainstream media, they're all telling you it's a bull market. Things can only go up from here. It's all good. Don't worry about anything else. It's all fine. You got to remember that these people have one job, and that job is to sell you something. Wall Street is a sales organization. That's all Wall Street is. They create product and they sell it. They're not out looking for your best interest. They're not out looking for your protection. They're not going to tell you to sell and go to cash. They'll never tell you to sell and go to cash because some event is occurring, right? Even when the markets are declining, you're down 30, 40, 50%, they'll tell you to buy all the way down because they're selling you product. And so in 2021, 2020, Wall Street was just providing all kinds of product. We were doing SPACs, IPOs, you name it, because there was this huge demand for all of these stuff. And so we were investing in SPACs, which were blank check companies. These were companies you gave money to that had nothing to invest in. You gave them money, then they went to try to find something to invest in. Then those worked out terribly, right? And we did IPOs. Those IPOs a lot of them lost 90% of their value during 2022. So retail investors were all happy, Bitcoin, right? They were all happy to buy crypto hand over fist. They were buying IPOs and SPACs hand over fist, and lost most of it in 2022. The drawdown for the average retail investor was nearly between 35 and 40% in 2022 versus 19% for the market overall. And that's because, as is always the case, retail investors buy the most at the top, they sell the least at the bottom, and they wind up having these massive drawdowns. So after 2 years of the recovery, we've had this massive recovery in the market. Retail investors are still about 6% underwater, but they're almost back to even because they're now piling back into the same characters we saw previously, piling back into crypto, piling back into small cap, speculative stocks that are making huge gains. And like SCMI, which is this small cap microcomputer company, stock is up like 3,000, 1,000% or whatever, but they're chasing you see these same kind of meme type stocks just roaring off to the moon. So it's that same type of mentality, once again, kind of permeating the market that will sustain the bull market for a while longer. But those will also be the individuals that get crushed when you have the next correction, whenever it occurs. And again, that may not be this year. It might be next year. It might be the year after. Again, these speculative kind of moves in the market can last a lot longer than you expect. But that's why we want to manage risk and be careful we're putting capital to work.
Okay. And not to, take pot shots at our friend, Mr. Dalio here, but that is the role of a speculative bubble, right? Which is to suck in everybody. And at the end, it suckers in all the dilettantes, the dumb money, right? And those are the people who generally experience the biggest losses and at the same time are the ones who usually can afford those losses least, right?
Exactly. Right.
Yeah.
And I've got an article that I've been pending for a while, and I'm probably getting closer and closer to publishing it. But, it's very interesting when you look back and you look at the average retail investor or just when you say, forget retail investor, just the average person, right? And you and I talk about these stats all the time, less than $500 in the bank, very little money, less than 1 year's income in 401k plans, et cetera. And you think about that, and then you juxtapose that to financial commentary. And I saw a really great piece of financial commentary from this guy on TikTok the other day. He's called the Millennial Economist or something like this. I can't remember his name. Anyway, he wrote an article. He says, "I've got a cure for Social Security." And I was like, oh, this will be interesting. The government just gives everybody $7,000 the day they're born. You give everybody $7,000 and the government just provides an account. And that money is all invested into the S&P. And then, of course, over your lifetime, as you get to 65, that $7,000 will magically grow to like $3 million a person. So you'll have $3 million in your bank account over your 65-year period. And then, the government then gets to tax that. So they make $1 million on their $7,000 investment. So everybody's happy and you've got all the money you need for retirement. Well, it's grossly inaccurate because markets don't compound at 8, 9, 10% a year. They average that rate of return, but they don't compound at that rate of return. 2022 will tell you that doesn't happen. A 22% decline wipes out years of compounding. So, the math is functionally wrong. But this is the information that we give to people all the time. It's like, oh, just buy and hold an index and you'll be fine over 30 years. Well, the other problem with that is the inflation adjusted value of that $3 million. Again, if I had $3 million back in 1980, and when interest rates were at 12%, I could live a very nice lifestyle on that interest income. Flash forward today, $3 million at 4%, given today's living standards, is not giving me the money I need to retire on, right? I mean, you're just not even close to where you need to be. And so these mathematical computations are always very wrong. But importantly to all of this, and this is the article that I'm going to write, is that we've had 3 massive bull markets. You had 1980 to 2000, and this is where people are living, right? I was born in 1965. So, I lived through the 80 to 2000 massive bubble in the market, 15% a year, average annualized rates of return. Awesome. Then I had the bull market from 2004 to 2008. And then I've had the biggest bull market on record so far, which is up over 400% so far from 2009 to present on the back of $43 trillion worth of interventions. Despite all that, despite these 3 massive bull markets, and supposedly if I just had my money in my 401k plan, I would have millions of dollars based on that, based on this idea that markets just magically compound over time. But that's not true. We can go look at the fundamental statistics. 25% of Americans have money in 401k plans. the average household has no assets. The bottom 50% of Americans have very little net worth overall outside of their house. The next 40% up to 90, they own very little of the equity market. As you've even pointed out before, Adam, 93% or 90%, whatever the number is today, is owned by 10% of income earners. And they don't have the wealth that suggests that these three massive bull markets have been inured to the value of what that is promoted through the media. And that's because everybody misses those periods of time where capital destruction wipes out years of capital appreciation.
True. And of course, the role of inflation too. And as you have said a lot, the don't look at the stock market to be your primary track to wealth growth. Even though if you get started early and do a lot of these things, you can give yourself a good advantage. I don't want to diminish the wisdom of, hey, if you can get money parked in when you're born to be in the S&P, great, take it, right? Yeah. But really, the chief goal of a financial asset investor is to just keep up with or outpace inflation.
Yeah, that's right.
All right, so let me bring up just one more headline here, which is, and then maybe Lynch, while I'm talking, you can pull up just the chart of the S&P and show folks where we are right now on the technical side of things. But there was an article I just saw the other day. The title of it was "Investors are finding it increasingly pointless to be bearish," right? And to me that seems like sort of one of those headlines you typically see at an extreme, right? If it had said increasingly pointless to be bullish, that's probably when you and I would really be talking about, hey, is this the right time to start, deploying capital into stocks because sentiment's so low? But extremes tend to be marked by capitulation, right? Which is a sentiment index. It's when one side just gives up and says, in this case, stocks look like they're never going to go down again. So let me just jump on in. How notable for you is this as a milestone? Because you're not only trading the markets and watching them closely, but you're talking to regular people every day. Are we getting to a point where, those that have held on and have used logic about, hey, I'm concerned about valuations or whatnot, but they're just getting beaten down by their neighbor who keeps bragging about his NVIDIA gains and are just jumping in? How, is this sort of a late stage cycle indicator?
No, absolutely. And that's what I was talking about earlier. When you take a look at sentiment, technical scores, et cetera, they're just grossly extended. Our weekly technical gauge, which is a composite of 13 different technical indicators, is in the 95 percentile range. It goes 0 to 100. So you're at 95% as of last week. I haven't measured it since Friday, but because it's weekly, right? So I'll measure it after the close of the business on Friday. But that's in the 95 percentile range. You take a look at sentiment, which is based, and our fear greed. So the CNN fear greed gauge uses some proxy for sentiments in the markets, like high yield spreads, and it includes the S&P index as a measure of sentiment. So I find it a little bit flawed because it uses the S&P to measure the S&P, right? And so that's that kind of negates that a little bit. So our fear greed gauge looks at how are investors positioned, because that's really the measure of fear or greed. How much equity exposure do they have? How much do professionals have exposed to the market? So our fear greed indicator also, by the way, theirs is in extreme greed gauge.
That's what I was going to say. Even if you think it's flawed, there's still an extreme greed. Yeah.
And like I said, I just don't like it as much as mine, because, and again, I'm biased because I created mine. Like I said, the flaw I find in their gauge is it uses the S&P to measure the S&P, right? And so, but it has some other very good indicators. That's volatility. It measures spreads on credit, which are all very good gauges. If you take a look at the spread between single B rated bonds and treasuries, people are not being paid for the risks that they're taking by buying junk bonds. So that's a very good sentiment measure that CNN uses. And so, there's real credibility to their gauge. I'm not knocking them. I just like mine because it says, well, I don't care about how you feel about the markets, because look, I can, tell you just from the people that email me from listening to your show, they feel one way about the markets. They're positioned differently, right? I'm terrified of what's going on in the markets, but I want to be as long as possible because markets are going up, right? So what's more important? How do I feel, or what am I doing? And so that's our gauge, which looks at how people are positioning themselves, the options market, the equity market, how much equity exposure they have versus cash and bonds, that type of issue. And that also is at a extreme level of greed. So we are just, sentiment wise, we are just getting very, very long, and we're getting very comfortable with what's going on. And there's a couple of interesting things that are going on. Let me share this, a couple of charts with you here real quick. With respect to this is something that Mike and I are watching very closely. So first of all, this is our chart of the S&P, and two things are going on. The market's continuing to kind of grind higher here, but we're in a very narrow range ever since November. So we trade to the top of this trading range, kind of these two blue lines in the middle. We just kind of trade to the top of that range, and then we come down to the bottom of the range, which also happens to be the 20-day moving average. So if you really want just a single indicator that tells you, okay, now something's happened, it's time to get out of the market, just watch the 20-day. If the market takes out the 20-day moving average, now it's time to start really paying attention to what's going on. At the same time, the markets are grinding higher. Momentum, which is the bottom chart, that's relative strength, is declining. So you have a negative divergence between momentum in the market and what the market's actually doing. That's a good indicator that there's some risk approaching we want to pay attention to. Same thing is with our MACD indicator. It just has been grinding sideways, but it is also negatively diverging. So that growth in the divergence between the moving averages is starting to close, but it's beginning to weaken at the same time. So again, nothing that says anything about anything at the moment, but certainly worth paying attention to these negative divergences. One thing I'm talking about in this weekend's newsletter as well is that we have one of the largest divergences above the 200-day moving average. That's this red arrow on the right. This is one of the largest divergences we've had from the 200-day moving average prior to any correction, and going back through history. And so when you start realizing that moving averages are like gravity, in order to have a moving averages, prices have to trade above and below that moving average. Otherwise, the moving average would be vastly different. So in the
it's not an average. Yeah.
So in the last 200 days, the market has traded both above and below that 200-day moving average. The current divergence cannot exist indefinitely. Otherwise, the 200 moving average is going to have to slope up very sharply to start catching up with the price if the market's going to keep rising higher. And that's certainly possible near term. But this divergence is going to close at some point, and the width or the deviation of that is so great now that gravitational pull is really going to start to weigh on markets. So tells you two things here. One is that this negative divergence of momentum. Also, when you talk about breadth of the market, one thing is that when we take a look at sentiment as a whole, we're starting to see some real deterioration in sentiment as well. So our Simple Visor sentiment index is at 100. It's as high as it can get, and so this doesn't tend to last long. When you take a look at the breadth of the market, this is the number of stocks above the 150, the 75, and the 50-day moving averages. You have the markets are rising, but you have this negative divergence in underlying breadth of stocks participating in that advance. And so ultimately, that's going to have to get reversed at some point. In other words, either all of a sudden stocks are going to rip them back off to the moon again on a broad basis, or the market's going to come down. And normally when you have these divergences of this type, where you have the market going up and stocks and breadth going down, that was basically the peak of the market in July of last year before we had that 10% correction. It's the peak of the market that you had back in the early parts of 2022 before you had the correction. So normally when you have these big divergences between stocks and the number of stocks participating versus the market, it generally winds up at a correctional phase of the market in the future.
Okay. So generally ends up in a correctional phase in the future. Again, I just sort of keep hearing from you, Lance, that you talk a lot about the analogy of the rubber band as it gets stretched, and the further it gets stretched, the more the concern becomes that the snapback is A, going to happen, and B, be more violent the more that the band gets stretched. You're nodding as I'm saying all this. So it sounds like you're getting increasingly concerned about the market environment. You are beginning to take more off the table or put in more risk management strategies. You're not like, it's not an everybody out of the pool movement for you guys, but you're beginning to become more and more defensive here, given what you just walked us through.
Right. Well, just from a, just kind of a very basic analogy, right? You're speeding down the freeway, right? And I don't know if you've ever driven on I-10 across Texas.
I have. It's like driving across the moon.
It is. It's flat, and you can literally see 20 miles ahead of you on the freeway because the road is completely straight. It's completely flat. And you can go, oh, there, you can literally see there is no traffic and no cops, and the foot goes down on the accelerator, and there you go off I-10. Well, ultimately what happens is that your exit, if I'm going to drive from, Texas to San Antonio, from Houston to San Antonio, straight road. But at some point, I'm going to have to exit off the freeway, either to stop at Buc-ee's, which is normal, or
I've been to Buc-ee's.
yeah. So I'm either going to stop at Buc-ee's, or I'm going to have to exit the freeway to go where. So when I know my exit's approaching, what do? Right? I don't slam on the brakes and go, theoretically in market terms, go to cash. Right? I just ease off the accelerator. I slow down. That's my first measure of risk management. Then, as my exit gets much more close, and I can see the evidence of my exit
ramp,
right, my off ramp, right. I see the sign. It says, half mile ahead. Maybe I tap the brake a little bit just to really start to slow down a bit. I move over in the right-hand lane. I put my signal on that I'm going to exit. Those are all cautionary moves. None of that is slam on the brakes and stop the car on the side of the road. I just know that I've got an exit approaching, and so I take some precautionary measures. As I begin to exit the freeway, I put my foot on the brake. I slow down more until I come to a stop, at the whatever happened, where I've got to turn, coming up next. And that's the same thing for the portfolio. So, right now the portfolio is fully allocated to equities. We're not removing positions. We're just reducing some positions that are. I mean, look, since we bought AMD and Nvidia, they're up between 70 and 90%, both of them. So, it's just ridiculous how much they've grown in just the recent, first couple of months of the year. So we're just kind of reducing those positions back to target weight. We're not taking them out of the portfolio. We're beginning to look at other things like, so in our models where we run options, we're buying very small a very small number of puts, and then writing some out of the money calls against those puts. So we're doing some cashless option collars in the portfolio just as a hedge. And so if the market declines, then that will help support the underlying equity portion of the portfolio. So there's things that you can do without taking on a lot of risk that gives you some ability to navigate that exit. And then at some point, if something happens, I need to exit much more quickly, then I can raise cash rapidly. I can, add on more puts. I can do whatever I need to do. I can short the market, but there's no reason to start heavily shorting the markets right now, because there's no evidence that it's time to exit from the freeway. The freeway's still fine right now. The market's still trending higher. We're in that trend channel. We haven't violated the 20-day moving average. We haven't violated the 50. So there's nothing right now that says short the market. Shorting the market heavily right now, betting on a decline, may not work here for a bit.
Got it. Just to continue your analogy, though, maybe you're just looking at the dashboard and saying, I've been driving far, it's hot outside, I'm a little bit worried that the car's beginning to overheat. And so I'm kind of looking to see where the exits are ahead in case I need to go off and cool the car off for a bit.
No, I don't care about the car overheating. Right. All I want to know is, look, right now, if I was running a 100% equity portfolio, I'd have my foot to the pedal and just be running. Right. I don't care that it's red, the car's redlining, whatever it is, that's fine. the market's not told me any reason to stop pushing the car at this point, right?
From a technical standpoint,
From a
yes.
technical standpoint, I've got no indication. I've got no flashing red lights. I don't have the engine light coming on. I don't have smoke coming out of the hood. Nothing like that. The car is just, we're driving a Ferrari and it's performing fantastic right now. So that's why I'm saying the exit is a much better example, because that is something that I need to reduce for, that is apparent, right? And right now we have no apparent needs. The car's running fine. It's humming right along. It doesn't matter that I've been pushing the car since November. See, that's the sentiment that gets people into trouble. They start worrying about things that aren't valid reasons, right? So we're always looking out. So in other words, this is people look, your analogy is I'm looking out the world long, and so I'm going to hedge for something long in the future that there's no evidence of just yet. I want actual evidence, and we don't have that.
Yeah, but just to make sure we're not confusing listeners here,
right.
But you're saying, hey, we are doing some things to trim and put some defensive, more risk management into the position. And so I was trying to use your analogy of like, okay, so maybe you're easing off the gas a little bit, right? Or you're just saying, in case I need to, let me just know where the exit is in case.
Okay. So yeah, using your example, I was pushing the car to red line earlier this year. So I go, I can't really keep doing that. So I backed it off to where I'm just running next to red line.
Okay. So that's more my analogy where I was thinking. Okay. Yeah.
Okay.
All right.
That I can agree with.
Okay. All right. So moving on here, because we're at my first bullet, I guess my second, because Januzian was my first bullet. Still get a bunch more to go.
You still call me Two-Face. I still haven't gotten over that one. So go ahead.
All right. So I don't know if you've got your RIA's net liquidity chart handy to bring up. If you don't, it's okay. But I'm going to bring up another headline. This one by Michael Every from Rabobank. He just put out a piece titled, "We're supposed to be in a restrictive phase of monetary policy. So what the hell is going on?" Right? And in the article, he says the following. We are, after all, supposed to be in a restrictive phase of monetary policy. Globally, we are at levels of nominal and real interest rates, which we thought were unthinkable a few years ago, in which many prefer not to think about now. Stay alive until 25 is still the mantra in some places. So in the article, he basically talks about how, prices of everything are rising. He rails about NVIDIA just the way that you did earlier. And he's basically asking the question that I think many viewers are still scratching their head on, and I've asked many times on this channel, which is like, Lance, I remember talking to you when the Fed first started the rate hike campaign, and you were like, they're not going to get above 3. Like, the economy just can't take that, right? And they've gone higher for longer, way higher for way longer than anybody imagined. And even still, we're at all-time highs in the markets right now, right? And so I guess the question that I have here, because we've talked a bit about this, but bring up your liquidity chart. I was interviewing Gordon Long the other day. His interview is going to come out actually the day after this one airs. Great interview, folks. Definitely watch it. If you've seen Gordon, you know he's a great interview. But he brings up a chart of fiscal conditions and shows that there's actually been no tightening of fiscal conditions since even prior to the Fed's rate hiking campaign. So it's sort of like, we're I don't want to say we're being duped, but this impression that we all have that conditions are a lot tighter than they were a few years ago. It actually hasn't manifested in the financial conditions side of the world. And obviously that sort of explains why we're at all-time highs here. By the way, folks, too, I've got Michael Howell coming on next week, who's the liquidity expert. So we're going to hear his side of the story too. So my question is like, what do you see winning out here? Is the liquidity just going to keep rising and everything else be damned? Or will higher for longer, if it continues sort of as is so far, will that eventually come to burn us?
Well, look, there are some things that are going on right now that certainly don't make a lot of sense. And for instance, if you take a look at the financial conditions index, it's at an all-time high. And now the last time that financial conditions were at this level, we were doing $5 trillion in stimulus checks to households. The Fed was cutting rates to zero. They were doing 120 billion a month in QE. We were bailing out junk bonds. We were bailing out institutions. We bailed out Boeing. We bailed out Royal Cruise Lines. And so, yeah, you have this massive surge of financial conditions. And financial conditions are back to that level. Now, I want to be clear here because I got an interesting email about this day before yesterday. The question was, yields on the 10-year Treasury are at 4%. Why is financial conditions so easy? Well, it's not just yields. Yields have come down. They were 5, they're down to 4. There's also the strength of the dollar. It's there's a whole bunch of other, the S&P index, others that all make up that financial conditions. So when you talk about financial conditions, sentiment is rising. If you take a look at consumer sentiment as a whole, consumer sentiment has been rising strongly, but sentiment about future stock market prices, in other words, what do you think the price of the market will be 12 months from now? The answer is higher. That sentiment is now back to an all-time high. So consumers are ultra confident about rising stock prices. That's easier financial conditions. Why? Because if I'm convinced that the stock market's going up, I feel better about things, so I got to spend money in the market. That's Ben Bernanke's whole premise behind QE, is to boost sentiment, to boost economic growth. Dollar's getting stronger, not weaker. All those concerns about the dollar collapsing, that's gone. And so you have all this other stuff that's happening in the market that's providing this fuel. And again, this is I had to update the liquidity index while you were talking, so this is my actual spreadsheet. So ignore some of the other stuff that's hovering around, but that's the index. And yeah, ever since the bottom of the market in October of 2022, that liquidity has been increasing despite this idea of quantitative tightening, despite the fact of higher interest rates. We're still supplying a lot of liquidity to the markets, and so markets keep rising. And it's not just financial liquidity; it's also, again, like I said, stronger dollar that's attracting massive foreign inflows into the U.S. right now. That's boosting assets. Sentiment is rising sharply. That's boosting asset prices. Nobody wants to be short the market, and they don't want to be out of the market. So that's boosting the market. So that's why the market's behaving the way it's behaving, and why financial conditions are so easy, despite the Fed, talking about needing to tighten financial conditions to, to bring down inflation. And so it's a real quandary the Fed's gotten themselves into, because everything that they've done didn't work to bring down the risk to higher inflationary pressures. In fact, they've got themselves backwards now.
Okay, and I'm going to trundle into inflation in just a second here. Your blue lines there show really big divergences.
Yeah, the reason for that is the last time we had this big divergence, you had a 10% correction in the market. And so I was writing an article, I think this was in last weekend's newsletter, maybe before, I can't remember where I used this chart, but the point of this is the market's got way ahead of the liquidity. And this is back to that why we'll probably have a 5 to 10% correction this year, is because you've got to reverse. You'll notice that by the end of that 10% correction, we were about equal with where liquidity was. So again, that's, we just got a very big divergence right now. And so markets are probably going to have a 5 to 10% correction to realign with liquidity.
Okay. So I'm just going to ask this question. So is this what Bitcoin is reacting to right now?
Absolutely. It's all speculative fervor.
Okay. So, I want to acknowledge and hand it to the Bitcoiners who, when Bitcoin was under 20, were still hanging around saying, this is a good investment thesis here. It has done very well this year, whether you think it's the right long-term strategy or not. And folks, I'm planning on bringing on a Bitcoin expert just to educate the audience here about it again, but also update it for what's been going on in the past 6 months, 12 months, whatever.
Well,
and if you're interested in that, let me know in the comment section below. But do you see
you got to be really careful with that statement, though, because this whole explosion in Bitcoin was around ETF issuance. There's been $46 billion piled into ETFs. They all have to buy Bitcoin.
Exactly. I'm with you on that. Yeah.
Right. But the thesis for Bitcoin was Bitcoin's going to replace the currency, all that. That is not what's going on with Bitcoin. Bitcoin is not the change of the fiat currency system, any of that. This is simply a function of now very easily. And again, I'm not poo-pooing the rise in Bitcoin. Don't get me wrong. I'm long Bitcoin. I'm long Ether for the same reasons. Is that those ETF issuances create demand for the Bitcoin. That has nothing to do with any of the fundamental principles around Bitcoin. And if you don't have an ETF tied to one of the, in other words, right now you buy Bitcoin because it has an ETF wrapped around it. Ether does not, but that's the next ETF to get issued. So that's why that's going up. Once you get outside of that into some of these other, sub $1 Bitcoin, I see a bunch of TikToks about, here's the 5 Bitcoins I'm buying because they're going to make me $10 million over the course of the next month. They have nothing to do with ETF issuance, and that they don't have the buying that ETFs are creating. So, the ARK Bitcoin ETF, the Grayscale Bitcoin, Spot Bitcoin ETF, BlackRock, Fidelity, that's what's driving the buying of Bitcoin. That's a very different environment from the thesis that was put out about Bitcoin. It's also a function that will be a problem for Bitcoin over the course of the next year or so, because now I can short ETFs. So I can create a lot of shorting against Bitcoin and Ether during a decline. So in other words, when we get to the next decline in Bitcoin, that move down will be exacerbated by the shorting of the ETFs that occurs when that happens.
All right. So you're making exactly the point why I'm saying I'm going to bring somebody on here, because I think that there's a lot of newness about what's going on and driving the price action versus just the thesis that many of us heard, years ago about it. And bring it up here because it's all about capital inflows going into those coins, and those are being highly driven both by the new ETFs, as you said, but also by the liquidity, which is getting pushed into those ETFs.
Right. And then of course, and that conversation also brings up here. Let me just grab this chart real quick. The rise in Bitcoin. And again, this goes back to the speculative kind of buying of what's happening, kind of in the overall market. We're saying this goes back to the whole retail investor thing and what's happening. And is that here? I'm going to use a different chart service real fast. It's not being a little slow this morning. But here's MicroStrategy, which is a software company. And this stock has gone from $500 to $1,000 over the course since we started issuing out Bitcoin ETFs. And this company has nothing to do with Bitcoins other than they bought Bitcoins and put it on their balance sheet and they use debt to do it. But their business line is software, right? And so people are buying this stock under the assumption that Bitcoin is just going to go to the moon, and so I'm going to buy this stock to get the return. And so people are, and this is a very small cap company, so you get this meme stock type movement, and then it's been a great trade, right? Because of this, I mean, you get a much bigger return on investment chasing MicroStrategy than you do buying the actual underlying ETF.
Yeah, look at that. Sorry to interrupt, but I'm assuming these are monthly candles.
Yeah, these are monthly candles.
In the last month, or I guess in February, it looks like it went from 500 to over 1,000. So it doubled in a month.
Yes.
Okay.
And that's the speculative fervor, right, that we're talking about in the market. And again, these type of movements can't last forever. And this stock is now approaching being as overbought as it was back in 2021 before it lost 90% of its value. And that's my point. We always, and then look, and I'm not, let me be really clear. I don't want you to get a bunch of hate from Bitcoin people. I'm long Bitcoin. I think it's fine. If you want to buy an ETF, it's completely okay. Make it a small portion of your portfolio, whatever. Just be aware of the risk. My whole point is I'm just saying be aware of the risk, because this asset class versus the S&P can lose 80, 90% of its value very quickly. And it's done it in the past. And once you start to get the spec, again, and with ETFs now, it really exacerbates this problem. There's not huge trading volume across Bitcoin. There's a lot of people that are just holding Bitcoin and they're not planning on selling it. So there's not a lot of volume that moves price. And that's why you get these very big price movements in Bitcoin very quickly. And MicroStrategy, as an example, is technically not actually, but it acts like a leveraged bet on Bitcoin. So if Bitcoin declines by 50% over the course of the next couple of years because of whatever event occurs, this stock's going to lose 90% of its value. And that's just that what happens when you unwind that speculation in these very low volume trading type companies. There's just a lack of liquidity that exists in the markets overall. And that's why we have this very these major exacerbated moves. There's a ton of risk here. But again, I'm not poo-pooing Bitcoin. Just understand the environment you're buying into and what the underlying risk of that is.
All right. All right. Well put. And again, folks, if you're interested in that Bitcoin expert coming on, let me know in the comment section below. All right, moving on. We touched a little bit on inflation. So I just did an interview earlier this week with Oliver Rust, who's one of the co-founders of Trueflation. Right. So very interesting conversation. Trueflation, basically, their goal is to try to come up with a measurement of inflation that they feel is more representative of what the average household experiences. And so it's really interesting because it actually is a blockchain-based platform, and it tracks over, like I said, over 14 million individual data inputs in real time. So unlike the BLS calculations that have a lot of assumptions in them and a lot of adjustments that can be kind of squishy, hedonics, substitution, that type of stuff. This is just like a brute force. Hey, we're tracking all these different goods and services, and here's how the price changed over whatever period we're measuring. So he was noting that inflation came down an awful lot, but they are now noticing that it is beginning to rise up again. Having talked to other folks as well, I think Lakshman Achuthan, when I had him on the program a few weeks ago, he had said that that disinflation has largely ended in a lot of other regions around the world, and inflation's beginning to tick back up there too. So we just had here in the States too, we just had the latest PCE data come out this week, Lance, and we saw that Supercore started rising again. In fact, every component of Supercore was rising. So my question to you is what are the implications, do you think, if inflation remains secularly higher from here?
Again, it won't. And the reason is just, it's just, again, you can't avoid basic economics. So look, 30% of people's household incomes are getting eaten up by food, right? So people are going to have to make choices, and you're seeing lots of it. There was a great article in the Wall Street Journal earlier this week of people now starting backyard gardens to help supplement their vegetables and intake there. People are starting to figure out substitute meals. Instead of making steak, they now make noodles with canned tuna, those type of things. So again, that's going to impact economic growth ultimately. And as economic growth slows, so does inflation, so does yield. Inflation is simply a function of supply and demand. And as we talked about before, it's just, nothing's going to go straight down. You're going to get these bumps. And so getting this little bump in inflation based on year-over-year comparisons is not surprising. In fact, it was expected because of what's happening in other areas of the economy. And when you're growing at 3.5% or 4%, like we've been doing since Q3 of last year, you grew at 4.9% in Q3, you grew at 2.9%, something like that in Q4. You're at roughly a little over 2% for Q1 of this year. Economic growth is slowing, but because you have that tick up in economic activity because of the money being spent by the government into the economy, right? And that's those infrastructure bills, that's the Inflation Reduction Act, that's the CHIP Act, that's creating this economic activity that is going to lead to some pressure in inflation. Inflation's not going to 9% again.
No.
It could very well tick up to 4. We were at 3% recently, and so it goes to 3.5, maybe it goes to 3.8, and then you're going to cycle through this again. And so it's going to go in waves as it continues to go lower. The implication for the market, though, is that the market may not get Fed rate cuts nearly as soon as they think.
So just as you let's hang on that. I just want to put in a quote here that came out today from Torsten Slok of Apollo. He said the Fed will not cut rates this year.
It's very likely.
Bold prediction on his part. I know that was it Larry Summers who said a few weeks ago he wouldn't be surprised if the Fed's next move was a hike instead of a cut. But let's just say that the Fed doesn't cut this year. What implication does that have for markets? Because they were.
That's the whole point. This whole rally has been this function that the Fed was going to cut rates 7 times. Then the market rally was, okay, well, they're only going to cut 5 times. Okay, well, now they're going to cut 3 times. And the first rate cut's coming in June. So that's why the market's been rallying. And so when the markets come to the realization the Fed is not going to cut rates, okay, so let me just tell you, I don't think the Fed's going to hike rates because they've been too clear at this point about the need to stop hiking rates. So they've been very clear about that they are done hiking rates at this point. Monetary conditions are tight enough for them, according to their statements. So I don't think they're going to hike. It's certainly possible. I just don't think that if the Fed wants to create a market downturn to reduce some of the if the Fed comes to the conclusion that I need to slow academic activity, I need to slow economic activity more, and I need to get unemployment up, I can do that by hiking rates and shocking the market because the markets are not anticipating a rate hike. So that would cause a market downturn of 10 to 15%, and you would get an immediate slowing of economic activity. Unemployment would probably tick up, and that would create that. And I don't think that's what the Fed wants. They're trying to do this controlled landing thing. So the easiest way to control that landing is just to keep promising a rate cut and then keep kicking it out to the next quarter because the market's addicted to crack. And so just like anybody else that's addicted to something, I say, well, I've got it. It's right here for you, but just hang on till next month, right? And I'll give it. I promise I'm going to give it to you next month. Next month comes like, hey, yeah, well, wait 1 more month, then I'm going to give it to you. And so the market will just keep dragging out this view of, okay, it's coming. I can see it. It's right there. I know we're going to get it. The Fed just keeps backing it up until they actually need it, which again, I don't foresee that this year. I think the real possibility is you start seeing rate cuts next year, along with much slower economic growth, a fall in inflation, and lower yields.
Okay. And as you look forward then, is it more sort of a stagflation, right? Where inflation's high, but as you say, the economic growth is coming down. So do you think just from a mindset, we should be?
No, inflation will fall with, you don't have the economic background to have stagflation. Like everybody looks back at the 70s and goes, oh, that's stagflation. You don't have that background here. So we don't have the dynamics in the economy to generate stagflation. Inflation is going to fall because once you start to get an economic downturn, services are going to collapse, and that's going to bring down your inflation. All inflation is coming out of the services side of the sector right now. So that's all going to start to come down as that economic downturn occurs and unemployment goes up.
Okay, I was just sort of thinking, you talked about how GDP growth is slowing, but you did talk about some of the things that are still pushing inflation a bit higher. Again, not up to 9, but could get it to 4 for a while. So, for a while we could have sticky inflation, but slowing economic growth, which I sort of think is
that's not really stagflation. That's just, it takes time for things to catch up. Economic growth is going to slow. And then as economic growth slows, you have a decline in demand, and particularly on this. And again, if you take a look at our economic activity, it's all on the services side of the sector. Manufacturing is still in contraction. Services is growing. So once you begin to hit that 80% of the economy that's services, then inflation starts to come down because all of a sudden restaurants, like Wendy's tried to do surge pricing that lasted for about 3 days. Yeah. So they're going to try to do that, but eventually at some point the rubber meets the road, and when you give up on services, then the rest of the deflationary pressure starts to hit the economy. Then the Fed will have to step in to try to navigate that soft landing. Otherwise, you're going to have a recession.
Right. Okay. So I mean, I think you're kind of singing my song sheet here, which is Mr. Lag effect, and that as folks just begin to go on strike on paying prices where they are, economy will slow, and then recession may or may not follow, and then the Fed, if it is going to scramble if indeed it looks like recession's beginning to win out.
Yeah, but real quick now, that all goes out the window. All that thesis goes out the window if the government turns around and sends $5,000 checks to households again. Or
I saw
an article yesterday or day before. There's a couple of people trying to pass a bill to send to give people a $5,000 tax credit if they will buy American-made goods. Now, that doesn't include certain things, but if you buy an American-made television or American-made, it doesn't include cars and a couple other things, but it's kind of small business type products in that range. And if you buy those products, you can get up to $2,500 for an individual, $5,000 for a household on buying these American-made products. So if you do something like that, you're going to wind up with another spike of inflation because you're creating demand against a backdrop of a lack of supply.
Okay. All right. I'm going to just give a quick little personal anecdote here about how I think more and more people are going to tap out of existing prices and maybe have to start substituting in the way that you were talking about, creating their own little victory gardens or whatever. I'm pretty clean eater, but I have noticed in my town for folks that eat pizza, we have pizza places where you can go and you can buy by the slice, right? And the slice is generous. It's a pretty decent slice, but it is definitely a slice of pizza. It is nowhere near a pizza in and of itself. At the lower price place, I think once you pay the cost of the slice plus taxes alone is pushing near $7. And then when they turn the little kiosk around and say, hey, do you want to tip me? You're kind of in the $8 range. At the more expensive place, it's over $10.
Yeah.
Right. And that's for a slice. So yeah, so once the price of a pizza gets to $10, or this price of a slice of pizza that gets to $10, people say, you know what? I'm gonna go to the store and get some pre-made dough and some, tomato sauce, and I'm just gonna make this myself at home, and I'm gonna have a whole pizza for less, a lot less probably. So we're getting to this point where I think substitution is increasingly just going to be forced on people because they're just like, I just don't have the dollars left over, once I get my paycheck and have to pay for this stuff, right?
Yeah, and yesterday I went and met a friend of mine. She's a brilliant CFO for another advisory firm, and we've been great friends for a long time. And about once every quarter or so, we try to hook up for lunch and just, talk shop, talk business, see what the trends are in the RA space, et cetera. And so we always meet at the same restaurant, so if you understand, most people don't understand Houston, but Houston is very interesting. There's these little pockets of wealth in Houston, and kind of regardless of what goes on in the world, these kind of pockets of wealth are generally unfazed. And so, restaurants do great because people are always, they have lots of excess liquidity. So they're always eating at these restaurants and they're always full. And so normally about once a quarter, we meet at the same restaurant. It's kind of in between both of our offices. And this restaurant is always packed. And usually there's a waiting line outside. And I'm giving away the punchline here because I keep saying there's usually there's usually a line out the door. And the last time we went 3 months ago, it was that way. It was just completely packed. We went yesterday and there was maybe 10 people in the whole restaurant. It was interesting because portion sizes were about half of normal for the same amount of money, by the way.
Yeah, shrinkflation. Yeah.
Yeah. So and there was literally no one in the restaurant. And again, this is one of those areas in Houston where it's right by a big shopping center and very high-end homes and just a very wealthy part of Houston. And again, it was a very interesting aspect considering where we were just 3 months ago. Yet at the same time, we have all this economic data coming out that says, oh, everything's just doing fantastic. The economy's great. We're booming. Services are running, just rip roaring. But again, very anecdotal, but again, very noticeable.
Great. And did you remember my litany from last week where I read through all those stats, which was hey, if you're hearing on the news that this is a Goldilocks economy and economy's GDP's strong and inflation's under control and unemployment's great, but you're not seeing that yourself and you're wondering if you're taking crazy pills, you aren't. Yeah.
Exactly.
All right. Okay. So kind of on a related note, we had some more jobs data come out this week. There's initial claims, and they're at they dropped again, not seasonally adjusted, and they're at a 4-month low. And I just want to bring up one thing to sort of just put in contrast to this, because increasingly, whenever the BLS is issuing jobs data now, I mean, there's just this immediate uproar from everybody saying like, we don't believe it. And even the Fed in their latest minutes said there's some real disconnects between, some of this labor data and what we're seeing, right? So I'm not going to read it, but I'm just going to show it. Here's a list that Zero Hedge put up of layoffs that have happened so far in 2024. And you can just see, I mean, these are big companies, these are big cuts, thousands of employees, anywhere from 5% to 35 to 100% in certain cases. We
don't forget the government of Illinois that just gave all their workers 0 work hours. Those don't count as layoffs, by the way. They just have no hours.
Are they still getting paid the same amount?
No, okay.
You're an hourly worker, you just don't get any hours, but you're not laid off, quote unquote.
Yeah. So their solution for paying for housing for illegal immigrants was to take their city workers and say, yeah, you're not laid off. We're not firing you. We're just not giving you any hours. And that may be a permanent situation. We don't know yet. So part of my comment about this is that all that list are big, high profile companies. And those are the ones we hear about. What you never hear about is the 50% of companies that are small to medium sized private companies. They don't report this stuff. They don't report their layoffs. They just, the owner of the shop comes in one day into the hair salon and says, hey, I appreciate all of you guys. Y'all are awesome, but I got to let 4 of you go. Whatever it is, you don't hear about that stuff, right?
We've talked about this because that's the drum I've been beating with that is that's killer, because that's where the majority of jobs are created, right? It's in those smaller companies, which of course, they don't have the deep pockets and the resources and the ability to do stock buybacks and all the other things that a lot of those names I just mentioned can kind of do to keep limping along. Yep. So again, kind of like your point on being nervous about how stretched market prices are from underlying fundamentals, and at some point it's going to catch up. I feel like, we're all telling ourselves that we still have this phenomenally amazing employment market, and we don't, for reasons we can begin to see more clearly in the data, but also if we're looking for it, but also, and I keep talking anecdotally, but like I just had a conversation yet again yesterday with somebody who's currently employed, has a job, is just trying to transition to a different company. And I don't know how many resumes they've sent out and doors they've knocked on, but they're just like, it's a really tough market to even get, there are all these open positions, sure, but to actually get a callback from these companies, in a lot of cases, they suspect it's just, people that are trying to protect budgets, right? I'm going to have the rec open to keep the budget I was allocated for it, but I'm not actually going to fill it, right? So I keep banging this drum, one, because I think, as goes employment, as goes the economy and the markets. We've talked a lot about that, and Michael Kantrowitz's HOPE framework and all that good stuff. And by the way, folks, I'm talking to Michael about having him back on the program. He's got a busy schedule, but I'm hoping in the next month or so, we'll get him back on for an update. I just want folks personally to prepare for this too, which is, I think that there's this narrative of, hey, don't worry if you get laid off. There are all these open jobs out there. You can just easily get another one. I'm not hearing very many people saying that happened to me, and yeah, I found a great job the next day. I'm hearing much more stories on the opposite, which is I got laid off and it's actually kind of like a ghost town out there. So I just want to make sure that people, if you are counting on keeping your job, if that is mandatory for your financial well-being, and especially if you're a salaried employee, you should really just be asking yourself, how safe is my company? How safe is my job at my company? And if I were to get laid off tomorrow, what would I want to do? What are the doors I'd want to knock on? You might want to start knocking on those doors now, at least just to see if it's even open.
Yeah. No, it's, this is something that we talk about a lot, but you take a look at some of these jobless claim numbers. These revisions are very interesting because the numbers keep getting revised. Higher. It's like, oh, jobless claims were X. Oh, they were actually Y. And we have all this, and even in the consumer sentiment data, that still just fascinates me. We just had consumer sentiment out, and they revised the last month consumer sentiment lower. And the last 4 months, they've been dramatically lower than what they originally surveyed. I'm like, it doesn't make any sense. How, I'm asking Adam, how do you feel about the economy? I feel good. Well, does you still feel good about it from last month? Because you said last month, well, I changed my mind last month. It's like, it doesn't make any sense why there's revision data, but we have all these revisions, and it certainly is suspect to a degree that says, how much weight, and again, look, let me be clear. We don't have any choice but to give these indicators weight. It's all we have, right? But you do have to kind of sometimes question the validity of the message you're getting relative to what you're kind of seeing with your own eyes. And again, we can't go by just, we can't make portfolio decisions based on what, I saw at the restaurant last week. It's like, oh, well, Lance went to this restaurant and there was nobody there, so that means the economy is crashing. No, you can't say that. Maybe there was something going on that particular day that I missed out on, right? But, the economic data is all we have to work with. We have to work with the data that we have. But I think we do have to apply some common sense to some of this as well, and saying, look, I realize that some of this stuff is the way it is, but it doesn't jive. And that's that risk that I'm talking about in the markets that I think we have to be aware of.
Right. And folks, this is why airplane cockpits have windshields, right? This is why they don't just fly by the dials, right? Yeah. Because sometimes dials can be faulty. So you just always want to make sure you've got the ability to look out and say, okay, are there really clear skies in front of me, or is there a mountain? Right.
Although I read a really fascinating article yesterday. I looked up, I Googled, you can do this yourself. Go Google top paying, jobs that pay more than $100,000 a year without a degree. Some of the jobs were kind of obvious, but the ones I had to laugh at was life coach. So what kind of life coach are you going to be without a college degree? I mean, like, am I going to go hire a life coach that has not done what I've done in life to be my coach, right? You never graduated high school. I'm not poo-pooing college, right? I'm not saying that at all, but experience is a big thing when it comes to life coach. So, quality over quantity. But the other two that made me chuckle was air traffic controller and commercial airline pilot. And the reason that those are funny, and there's actually several more in there when you start reading them, because they all require an extensive amount of schooling. Yeah, you didn't go to college, but to go to be a commercial airline pilot is hours and hours and hours of study and education to learn how to fly an airplane, pass all the requirements. So you don't get, and I love the last line of the article I was reading. It says, these jobs are available if you're willing to put in the work. Well, isn't that the work of going to college and getting a good degree, right? Not a degree of, basket weaving or whatever, but, getting an engineering degree or a math degree, something that's going to pay you money. It's just interesting. There's no, and the point of this is that there's no free lunch. And at the end of the day, we're going to have to all pay that price, and one measure or the other to get to where you want to be. But, I just, again, Google these jobs, and it's quite interesting.
Oh, all right. Interesting. You brought up the pilot thing too, just because I've got a friend whose son is 17, but is known for years he wants to be a pilot. In fact, already knows the airline he wants to be a pilot for, and he's actually going to, I guess, what I would call airline college. And I don't know if it's would be considered a college degree in the way that.
No, it's not. It's just considered certification.
I guess, but he's going to be there for 3 years, and it's a crap ton of, he's already got a bunch of hours. He's already got his pilot's license, but he's going to have to go there and go through the, to your point, he's got to put in the hours. He's got to do the work. Yeah.
It's not easy. And that's the whole point, is like, nothing's easy. You can try to skirt corners and do these things. And look, I get it, right? College gets a lot of a lot of bad press because of what colleges have done, and right. They require you to take classes that are just stupid. It's like, why am I taking this course? It has nothing to do with anything. And a lot of it's pushing an agenda or pushing a message, whatever it is. And so I certainly get that, right? But to tell individuals like, oh, just don't go to college because it's not worth it, I think that's a faulty message, because, and that was kind of the premise of this article, is like, college isn't worth it anymore. Here's all these jobs you can get that'll pay $100,000 a year without a degree. You're still going to wind up getting educated. Nobody's going to hire you for $100,000 a year out of high school with no education, no experience, right? And this was an argument I made 10 years ago. I said the problem with, and this started right after the Obama administration took over the student loan payments and took it away from private banks and private lenders. Because back then, back in the old days, you had to actually qualify for the loan. You had to, your parents had to co-sign for it. You had to qualify for it. And it was very specific on what you could use the money for. And the Obama administration said, hey, let's just take that over and we'll just give loans for whatever we want to everybody. And they can just go to college and it'll be great. Everybody have a college degree. And I said, this is a huge mistake because the value of the college education was its scarcity. In the 1930s and 40s, the average education level for Americans was 8th grade. In other words, if you applied to 8th grade, once you graduated 8th grade, you went to work on the family farm, you went to work for, the welding company or the construction company, whatever it was. The average education was 8th grade. So if you had a high school diploma, you were like, that guy's a freaking genius, right? He's going to be the manager. And then we said, well, everybody's got to have a high school degree. And so it had no value at that point. So then it became the college education. And that was scarcity. And now once you start putting, and then this was the problem I said, 10 years ago, I said, once everybody goes to get this college education, they'll rack up a bunch of debt, but it's not going to have the value because it'll become the norm. It'll become the high school diploma, which is exactly what's now has happened. And now we're in this whole big debacle of the value of the education, all this. But the bottom line though is that, you've got to have that educational structure. It just has to be in a field or in a trade that has value to the economy. And that's the message we're not giving to our kids.
So you're ranting on me, and we can't rant on this because we've done it in the past, and I've got other rants we got to get to. But I agree with everything you're saying.
I won't rant anymore. I'm done.
That's right. We've talked a lot about this, and look, I'll freely admit I have been a vocal critic of the average college experience has devolved into, to the point where I think I've made the statement. I think on average, college does not deliver a positive ROI for the average student going through it when you take into account the lowered standards and experience they get educationally and the exploding cost of college, right? So I've been a big fan of alternative paths, as we've talked about here, and I think we've talked a lot about sort of the apprentice model, which is a great one. And that goes to the heart of what you're talking about, which is you get to put in your hours, and it's almost sort of like the Malcolm Gladwell, like 10,000 hours until you have true mastery. And that's in value creation. And that's in creating something that the market values and will pay you for, right? So I'm right there with you. There is no free lunch. All right. So we could talk about this for a long time. I want to talk about it for just a minute, just to note it. The question I was going to ask you to debate is how big of a deal is the commercial real estate threat right now? Talking to Gordon Long, he thinks that's high in his list of triggers of what could get the system out of the hands of the central planners here this year. I want to note a headline that there's a top Canadian pension fund that's sold an entire Manhattan office tower for $1. Recently, where they basically just said, look, we're just throwing bodies out of the balloon at this point, trying to just jettison weight and reduce our exposure to commercial real estate. So you're beginning to see panic selling is what that headline tells me. So real quick, Lance, how big of a risk is this in your mind?
Well, I disagree with Gordon Long that the commercial real estate issue takes the issue out of the hands of the central planners. I think it puts it into their hands. And I think it's the opposite, because you're talking about essentially, to a degree, the next financial crisis, which is if the commercial real estate property, issue explodes to some level, and all of a sudden you have massive defaults on commercial real estate. And then again, that's likely. I mean, there's, we're not over that hump by any stretch of the imagination of what's happening with commercial real estate. In fact, that is something that's going to be processing for the next couple of years. We have a big debt wall that's coming up, particularly for a lot of real estate companies in the small and mid cap space, in particular in 2025 and 2026. So, what will happen is if all of a sudden you start getting massive defaults, the government's going to step in and start bailing out companies again. We're going to drop rates to zero. We're going to do QE. We're gonna, we'll underpin the banks on commercial real estate. I mean, look, you had Silicon Valley Bank sneeze with good collateral back in March of last year, and we bailed out all the banks. So, again, this will simply be just the next iteration of why the Federal Reserve has to come in and bail out stuff.
Okay, so I actually think you and Gordon are similar. Where I meant it right now, there's a central planner organized tranquility to things.
Yeah.
And this could be the thing that adds a lot of, turbulence to it, to the point then when you're saying they have to come in and it's big enough, they have to come in and start doing these big
Right.
programs again.
So and that's what I meant by putting it back into their hands. So
Right. I think Gordon would agree with that, just to be super clear.
Okay. Well, I'm sorry, I haven't heard the interview, and so we probably agree. But I guess my point is right now everybody kind of it's like that it's that thing in the room that nobody's paying attention to that all of a sudden just gets everybody by surprise. And
well, is it gets it by surprise, or is the thing in the room, the elephant in the room, nobody's just acknowledging until it actually starts stomping around?
Yeah, I mean, I guess that's what I'm trying to say is that everybody is aware, and then so this is everybody commercial real estate issue. Everybody's aware of it. We all know about it. We've all talked about it, and as long as nothing blows the thing up, then we're okay. And again, maybe what happens is that all these companies like this Canadian pension fund, they just start liquidating their assets at ridiculous prices, which transfers the risk, gets rid of the risk on their balance sheet. They just take a heavy loss. They write it off their books. The rest of the market's okay right now, so it's not a major impact. Then somebody else picks up that property at a deeply discounted price, and they have a good asset going forward because they buy it at such a deep discount. If enough of that occurs to get all of these properties repositioned and get that debt off the books, and the banks take the hit a little bit over time, right? You're probably okay. The risk is something that happens that causes an immediate default across the platform all at once. That's the Lehman moment, right? You had a default with Lehman, and everybody just stopped. They said, we don't trust anybody. We're not going to trade with anybody. That's what caused the problem. If they had just slowly unwound Lehman very quietly in the background, probably would have never had a financial crisis. But I think that's a lesson the Fed learned. And I think what the Fed will do is lean on these banks in particular behind the scenes to very quietly deleverage themselves in these areas to keep that from happening. I may be wrong, but we'll see.
All right. And like I said, we could talk about this for a lot longer. Maybe we will next time. All right. Just in wrapping up, here's sort of just some news you can use. For anybody who's watching that tax time is coming, if you are in need of a new CPA, just be aware that there is a massive shortage right now of accountants. 75% of CPAs are now at retirement age. And so I've had a couple people approach me saying they're looking for an accountant. In fact, I am now shopping around too. And initially, every door I was knocking on just said, "I'm sorry, but we're just not taking new customers right now." And then I got online trying to figure out what's going on, and I learned that there's this massive shortage going on now. So it's just something to be really aware of, especially again, if you have an accountant who's near retirement age, you should be looking around for their successor if they're a one-man shop, if they're not going to transition to somebody who's additionally on their staff. Because this is not a problem that it seems is going to go away anytime soon, unless everybody says, well, AI is going to ride to the rescue, and the IRS is well, I mean, the IRS is hiring a bunch of auditors. It doesn't mean that that's going to help you out. It probably means the fact you need to have a good accountant to do your books even more. So, right? But I've actually I've raised this on Twitter, and a lot of accountants have chimed in and said, yeah, it's the real deal in our industry, and a lot of them said, and I'm even getting near to the end myself. And the people who are saying AI is going to ride to the rescue here, they're saying maybe, and they're even saying I'd love that because I'm overworked, but it certainly doesn't seem to be riding to the rescue in time. And obviously, goofs like this week's troubles with Google Gemini, don't inspire. You don't want your AI, kind of hallucinating details about your tax returns. So, AI is not going to replace real people until we've got really good confidence that those hallucination risks are over. So anyways, the point I just want to make is if you are in need of an accountant, start beating the pavement soon, because this process takes a while to find a good one who's still willing to take people on in their practice. And if you've got a good one, but they're further in their career, don't get too complacent, because if you all of a sudden find that they retire and you've got to find a successor, it's not easy pickings out there right now. Lance, I'm guessing you hear the same from your clients?
I do. And I was just Googling while you were talking about right now about, how many students are taking, becoming accountants in college.
A lot fewer.
Yeah. The total projected accounting enrollments are down 4% from the highs in 2016. This is of 2019. That's fallen even further. So, again, this is what I was talking about earlier with choices in college. Here's an opportunity, that is a high paying job, and there's a real lack of, bodies in that space. So here's a great career to go get a college degree in that will pay for itself down the road.
Right. And you should have a lot of, job security, and especially
Yeah.
given where things are going tax wise. Here's a quote from one of those accountants that responded on Twitter. He said, "I'm an accounting and finance professor. We cannot train or educate enough prospective CPA students to even come close to satisfying the demand." So again, I don't think much of us think about the tax or accounting world if we don't have to, but it's a reality of our lives, and it's in crisis, and that crisis, is going to spill over into those of us who aren't paying attention. All right, well, for this week's rant, and we'll keep it short. I was having this discussion with my daughter the other night, and I left it not feeling so great, and I want to share why, because I think it's instructive for folks. We're going on vacation in 2 weeks, right after the spring conference here, the online conference for Thoughtful Money. I'm going to go rest and relax, but it's also her spring break, and that's her last spring break at home. She's a senior in high school, so we want to make sure she has a good one. And we were talking about vacations, and she was like, "All right, Dad, are you really going to be able to relax on this vacation?" And I'm like, "Yeah, I always relax on vacations." She was sort of like, "No, you don't." And I was like, "Really?" And she's like, "Yeah, sometimes, you get so like, intense about work that, it's hard for me to relax." And I was like, "Really? Like, can you give me an example?" And we kind of went back and forth. And look, I know that my tendency is to be a bit of a workaholic, so I'm sure there's definitely real truth on her side of the equation. But I like to think of myself as a pretty easygoing guy and whatnot. But clearly, she has a different experience, right? And it really got me reflecting, because she's my last child. She's leaving the house, and I'm just sort of thinking like, it bothers me that she has these sort of negative associations about vacations, at least where my work is involved. And it got me thinking about that old expression: it's not what you do for people that they remember; it's how you made them feel.
Mhm.
That's what they remember.
Yep.
And so it really got me sort of processing. There are, it's sort of like a Dr. Phil moment, right? Where on his show, somebody would be ranting about how they're totally right, and he's like, "Yeah, but how's that working out for you?" Right? Like, sometimes you can win the battle but lose the war. And so as a parent, I've been sort of wrestling with the like, yeah, I guess I sort of lost the war on providing happy, vacations for my kids. And look, she said, "Look, Dad, it's not like you were a tyrant and I don't have these happy memories." She was just like, "I just kind of remember you as always being a little, too down the work hole." Um, so I'm taking from that, all right, well, that's something I got to really be much more mindful about going forward, starting with this new vacation. But also too, there's the other side of that coin. Maybe we're back to the Janusian topic here, the two-sided topic, which is, sometimes as a parent, you know, you have to prioritize what your role is going to be, right? And for me, being a provider, I look back and reflect on some of those vacations where I had to work, and part of me doesn't regret it. Where I was sort of like, well, look, it was important for me to make sure that whatever I was setting up so that I could support my family was getting set up and being managed well. And so it's this kind of push and pull of who we want to be and what we want to be remembered for. And sometimes those can be in conflict, right? Sometimes you can't be the happy-go-lucky guy and the provider at the same time if the situation doesn't allow you to be both, and you got to make a choice. And I'm not necessarily, trying to soliloquize here to push people to one side of the being one versus the other. It's just about being really mindful of that. What do you want to be remembered for, right? And like, it'll hurt my heart a little bit that I'm not maybe going to be remembered so much as the fun vacation dad. But when all is said and done, if she remembers me as the guy who did whatever it took to provide what my family needed, and maybe sacrificed some of his, quality of life to make sure that the family had a higher quality of life in total, like, I can live with that, right? So anyways, you're kind of nodding as I'm saying this, but it's you know, you and I have talked about the importance of relationships, and we've had some losses in our lives that we've talked about here. What you want to be remembered for is really important. I guess my point is if you don't be really mindful of how you want to be remembered and work to make that the memory folks have of you, they're going to have whatever memory of you they have, and it might not be the one that you want.
No, I mean, it's yeah, you and I have talked about this. I mean, my work day used to be when my kids were little, when they were babies. I would get up at 5 in the morning. I would go to work, and I'd work until 5 in the afternoon, and then I did a radio show from. Sorry, I worked till 4 in the afternoon, and then I did a radio show from 4 o'clock to 6 o'clock, and then I did another radio show from 6 o'clock to 8 o'clock. So I got home around 9, and so that was okay because that's what I had to do to generate, build our business and the things that we do now. And I was very fortunate that my wife understood that that was a requirement, and so she took over that whole house role of making sure the kids were taken care of. And the whole time that I was working, she was like, "Hey, yeah, your daddy's at work, but he loves you, and he'll be home soon, and he'll play with you when he gets home." And they always stayed up a little bit later than they should because she'd wait for me to get home, and then I'd spend about an hour with them, and they would go to bed. And so, but she was very supportive in that role to making sure that the kids always understood that what I was doing was important. I wasn't neglecting them. It was just incredibly important for them to have all the things that they wanted to have. And now, as they've gotten older, I've had this conversation with them. We regularly go out to dinner as a family, and we'll say, "What was your best memory about this or that?" And they always go back to our vacations. "Oh, remember that time that we went skiing in Taos and then this happened, that happened. I love that. That's my favorite memory," whatever it is. And so they have these really great memories because we always spent time to make sure that we built memories with the kids. And that was my wife's always her saying, which was, nothing else matters as long as you build good memories. And that's to your point, right? Is that as long as you can build the good memories, the rest of the stuff we all forget about. I can't remember the minutia of growing up with my dad. My dad was a very strict disciplinarian. He worked all day for Dow Chemical, then he taught tennis at night until 10 o'clock. Then he'd come home and string rackets till 1 in the morning. And, he was very strict and very driven, probably where I get it from. But where he failed was that he never created the memories. So all I have is my memories of my dad being a very strict disciplinarian that worked very hard. And I love him, right? I mean, he's passed away now. And I love him. He was a good father, but I don't have tremendous numbers of memories where it was this really great time. I mean, he took me fishing, and that was his thing, right? He loved to fish. So we'd go fishing on the weekends. I have those memories, but I don't have all these other memories like I've tried to build with my kids. And I think that's the important thing is it's not the quantity of the time that you give your kids, it's the quality and being present. And that was something my wife taught me. It took me 40 years to learn that, but I think that's the most important lesson that she taught me was it doesn't matter how much time you spend with your kids. Just make sure when you're spending it with them, that's what you're doing. You're not thinking about work. You're not kind of half working while doing something else. And that's why, look, I've played Barbies, I've played video games. I do, all the stuff that my kids wanted to do, always made sure and did it with them.
Yeah. All right. Well, really well said. So, parting bit of advice here is just, for the important people in your life, ask yourself, how do you want them to remember you? And then say, okay, regardless of what happens and has happened in the past is a sunk cost. What memories can I create going forward with them to hopefully help them remember me the way that I want to be remembered?
And they will, because we the memories that we file away are the ones that we remember. And so if you don't have a lot of good memories to fill, right, in the past, then all the new memories you create fill those spots, and they don't remember that stuff. They just remember the stuff you do. So yeah, it's never too late to start. Just start.
All right. Well, look, we're going to have to end it here on those words of wisdom. Folks, just some important housekeeping as we wrap up. And first, if you are, wake up in the morning every Saturday, bright-eyed and bushy-tailed, just can't wait to make your coffee and sit down and listen to Lance's wisdom on these weekly market recaps, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it.
Also, you find something else better to do is what you need to do.
Well, also a reminder, folks, that the conference is coming up really fast, and early bird discount price, the lowest price we were offering, expired yesterday. But because so many people email me the morning afterwards saying, "Oh my gosh, I just missed it. Is there any way I can get it?" I'm going to extend it until midnight tonight. So if you're watching this Saturday, the day that this Saturday, March 2nd, I believe that is the day this video launches, you can still lock in that early bird price, just because I don't want to get bombarded by all the people today to do it. But it is your very last chance to lock in that price. So to do that, just go to thoughtfulmoney.com/conference. And again, if you're a premium subscriber to our Substack, you get an additional $50 off whatever price we're charging by using the discount code that's been emailed to all of our premium Substack subscribers. Last, as Lance talked about, there's a lot to be concerned about in terms of market valuations, overbought extremes, all the bubble issues that we were talking about at the beginning of the discussion here. If you are navigating this yourself, I would highly encourage that you, well, as I always do, work under the guidance of a good professional financial advisor, but be considering putting additional risk management into your portfolio, just the way that Lance is. If you've got a good financial professional, financial advisor who is doing that for you, taking into account all the things that Lance and I have talked about here and that my guests and I talk about in this channel regularly, great, stick with them. They're extremely valuable and likely to be even more so if things play out the way that Lance thinks they could from here. But if you don't have one, or you'd like a second opinion from one who does, maybe even Lance and his team there at Real Investment Advice, then consider scheduling a free portfolio consultation with them. I can't really think of any reason why you wouldn't want to do it. It's just free additional guidance that you can take into account or not, totally up to you. To do that, just go to thoughtfulmoney.com, fill out the short form there, hear what they have to say after they understand your personal situation and give you whatever advice they have. As a reminder, these things are totally free. They don't cost you anything. There's no commitment to work with these guys. It's just a free public service that they offer. All right. With that being said, Lance, as usual, I'm going to let you have the last word.
No, really. I mean, it's just, we'll just continue to kind of navigate the markets the way they are. And, again, we publish a lot of work on our website at realinvestmentadvice.com, daily market commentaries, a lot of stuff that, in between Saturday and Saturday, you can get our daily market commentary, our blogs, and a lot of the stuff that we talk about here on the show. It's all at the website. It's free. So realinvestmentadvice.com.
Great. All right, Lance. Always a great doing these with you, buddy, week after week. Thanks so much. Really look forward to seeing you next week. Everybody else, thanks so much for watching.